the states continuing to threaten more tariffs and actually imposing them in the next few months, we'll probably see another rate cut on the horizon. But there are a lot of renewals coming up. And so partially also it's, the Bank of Canada also being careful, I guess. In the end of the day, we do have a lot of first-time buyers that went out and bought their homes shortly after COVID, and a lot of those 5-year terms are going to be coming due now.
Welcome to Supply and Demand with Adam Nadler. This is a podcast dedicated to the real estate market in Canada, available now on YouTube, Apple Music, and Spotify. All right, Konstantin.
Yes, sir.
You are the mortgage expert. So we just saw rates drop today by 25 basis points yet again, making it a full 2%. 200 basis points have been dropped in the last 6 months. Talk to us about this. How much is this really affecting things on the mortgage side of things for Canadians right now?
Well, I think we'll see that in the next month or two, how it really affects us. I think as much as we all were hoping that the Bank of Canada would continue lowering rates past the last rate cut, I was actually not sure what was going to happen this month of January because the employment data was coming back rather strong at the end of last year. But then Trump came out with his idea of tariffs, and then I guess everybody got a little scared what that might mean in terms of just basic things, right? And how that might affect Canadians long term. And I think that today's decision for the Bank of Canada to lower rates is actually partially because of those pressures, because Canadians are struggling with housing expenses, they're struggling with inflation that, may in the small short periods of time may not seem so high, but when you look at how far inflation ran away in the last 3 to 4 to 5 years, it is actually quite staggering, right? So everybody's feeling it, and so this rate cut um, is sort of feeding into that narrative. And I think that like if we see things get worse with the states continuing to threaten more tariffs and actually imposing them in the next few months, we'll probably see another rate cut on the horizon. So that is going to take a lot of the stress away from people that are renewing. Well, not maybe a lot, but a fair amount of it, because they'll be probably looking at better renewal terms. But there are a lot of renewals coming up, and so partially also it's the Bank of Canada also being careful, I guess. In the end of the day, we do have a lot of first-time buyers that went out and bought their homes shortly after COVID, and a lot of those 5-year terms are going to be coming due now, right, in the next year or so. And so there's a lot of those pressures. So in terms of Canadians, how they're going to be affected by this in the short term, not 100% clear. In the long term, we are going in a direction of lower rates, lower cost of borrowing. There's a bunch of developmental levies and charges that are being waived by various municipalities that is going to generate a little bit more construction business and a little more construction activity, because we've seen such little construction activity in the last 12 months with cost of materials and labor, and also just the cost of borrowing being so high that a lot of the time the economics did not make sense. So I think that in the next few months we'll see quite a bit more activity because people are feeling a little more positive about the rates improving. Fixed rates are improving very slowly. They're mostly driven by bond yields more so than the Bank of Canada choices on policy rate. But it's all kind of this big ecosystem, right? And it kind of is. It's very wrong, I think, to look at any individual one thing and sort of judge what's going to happen next based on that one thing. Like, for example, the cutting of the rate. But I think if you look at the bigger picture as to what's happening with Canada and the States, and where we are in this last sort of I call it this 5-year cycle that we're in post-COVID, I think that the general trend is such that we're going to be seeing probably quite a bit more activity and a little bit less cost of borrowing.
Isn't that rather dangerous though? Like, aren't people afraid, or should they be afraid when we see the Bank of Canada kind of do these massive, massive swings that are super aggressive, right? Lowering interest rates by basically just, I mean, right to zero. right at the beginning of COVID, then raising interest rates almost as quickly as we're seeing them lower them now, right? At just a staggering rate, going basically from zero all the way up to 5% in the matter of, I think it was like 18 months. And
Yeah.
now lowering 2% over a matter of 6 months with further rate cuts probably coming. It seems like these massive swings where it's almost like panic on every front always. It's like kind of panic swing in this direction. Oh no, we went too far. Now let's panic swing in the other direction. Shouldn't this be concerning people? Because if we're seeing panic cuts happening right now, which that seems to be what's happening, shouldn't we expect it to kind of swing again in the other direction eventually over the next, let's call it 1 or 2 years?
Not impossible, right? It just depends, I guess, how everything reacts to these cuts. Like if you look historically at the previous rate hike cycles, and I think we may have even spoken about this on your podcast several moons ago, but the rate hike cycles generally don't last. Like when you were talking about doing a looking at, let's say, the last 50 years of rates, last 50 years of uh, Bank of Canada choosing what kind of a premium they're offering to the customers. Rate hike cycles generally don't last more than maybe about a couple of years. Sometimes maybe 3 years. I think the longest ones I've seen when I was looking, and this was a little while back, but I was looking, I think it was 36-month cycles, right? Like it does this and then it comes down. And typically after this shock therapy, everybody is quite a lot more cautious for the next little while. So when these rate hike cycles happen, they peak, right? They come down really quickly, like you pointed out, and eventually they sort of stabilize for the next little while until there's another black swan or there's another development or what have you. And then, like, if we look at the last 30, 40, 50 years of historical data for rates, that seems to be the theme, right? And then, like, is it possible, for example, that we'll see another rate hike cycle just as aggressive as the last one? Something very major has to happen, right? Is it going to be like, can we have another COVID to throw a wrench into what we're doing right now? It's hard to predict, right? Like, but because of how much commotion there is politically in the world, like for example with these tariffs, like these are not predictable things, um, right? Like I think Canadians were a lot more excited about certain things last year when it came down to politics in the States, more more than they are right now because of the tariffs, because that's the unexpected. That's sort of your mini black swan, maybe not as hard as COVID, but still is something that is going to affect us and our confidence as consumers.
And then I guess, how does that play into the dollar? Because that's also affecting our economy in a big way, right? Where now at one of the lowest points we've ever been at for the exchange rate with the US. And
That is correct.
that's affecting us in a huge way. It's becoming incredibly expensive to buy from the US. And I do know that this is generally can also swing both ways in the sense that, Japan did this too, right? When they weren't competitive enough, they lowered rates, they devalued their own currency on purpose. And then they were doing yield curve control for what, 20 years? And at first, it made them hyper competitive and frankly made them rich for a while until the bounce back, right? Until the elastic snaps back. And now they're in a position where they can't even unravel that yield curve control, or else not only will they crash their own economy, but they'll also crash the US because they're holding so much in US treasuries, just like Canada does, that if they fall, they're kind of forced to sell them, and that also hurts the US in a big way. So it's kind of like this massive, like you said, ecosystem where there's not one thing that you can point to generally, like this Bank of Canada rate cut. But when you kind of look at the massive machine that's kind of churning and moving here, um, it does seem to represent a lot of big problems that we have in centrally planning the economy. So talk to me about that. Like, how is the Canadian dollar affecting mortgage rates, the real estate market, the broader picture as a whole?
Well, I mean, as far as the dollar goes, like obviously the Bank of Canada has to be very careful. They keep lowering rates, and we're um, losing our dollar is losing value actively, right? Like they can't do it too aggressively, which is why they're slowing down a little bit. Um, but sort of on top of this bigger picture. But the other thing as well is CMHC insurance, right? CMHC is the Canada Housing and Mortgage Corporation that insured all these purchases with less than 20% down in the last 5 years. I just wonder if all those people that bought in 2020, 2021, 2023, maybe, right? If they had to go and refinance, or if they're not in a position to maybe keep their home and they have to sell it, and if, let's say, these rates didn't come down anymore, let's say they stayed, right? And people start listing their properties and selling, I wonder if CMHC would be solvent. Because if they had to pay out all these insurance policies and all these properties that have a loss because of how much the equity eroded, like it is kind of like a house of cards. So because of how much everything is interconnected, you know, like same as Bank of Japan, we are kind of interlocked into this. And so if you start getting too aggressive in any one direction, you start seeing the house of cards crumble. And we can't allow for that because that would bankrupt the Canada Housing and Mortgage Corporation and it would just kill our insurance product, right? It would do so much damage. It would do more damage than good. So it's almost like lowering the value of Loonie and making us poorer is safer than letting the freaking thing tank.
On the topic of the CMHC, they have now, and if they are insolvent, if things do go poorly, I guess they're a Canadian corporation, right? They're a crown corporation. So I guess the government would just bail them out and doing so print money, which would then create inflation. So, and we know how that story goes. But
That's right.
is there any auditing that's done of the CMHC to make sure that they do have the money?
I actually don't know. It's a good question. It's a good question. I mean, I'm sure they have some sort of a structure that verifies that they have some level of payouts available. But I don't think that insurance companies work on the basis of an ability to make payouts on all of their products. Like I don't think that's a risk model that anybody considers.
Right. Just like AIG didn't have all the money to pay out all the derivatives, right, in 2008. Just like all the banks don't have all the money, right?
That's
They're
right.
they're they're lending out at a well, it used to be a 10-to-1 ratio. Now I think it's just whatever they want. I'm not sure that those guardrails are there anymore. But it's like we can't I don't think anybody in their right mind expects the banks to have all the money when,
No, they
things
don't have any money.
they don't have any money, right? They're lending it out. That's their purpose. That's their
They're
job.
they're gen they're generating money by lending it out, right? Like a lot of the CMHC stuff, like nobody physically goes to the vault. The button gets printed, the commitment gets printed out, and then the money just somehow randomly, magically appears.
Right. It's money
Um,
creation. It's private
it's
debt.
money creation. Yeah,
Yeah. It's private debt, which is essentially money creation, similar to how the, government sells bonds to the Bank of Canada for public debt, which is also another form of money creation. But ultimately, it just seems like we're in a cruise ship that, we have kind of governor of the Bank of Canada, Tiff McClem, is at the helm with that huge wheel in front of him. And he's like spinning the wheel in one direction really hard for like 18 months, just throwing the wheel to the left as hard as he can. And then
that's right.
panics and throws the wheel in the opposite direction as hard as he can. And it's like when you're steering a cruise ship, I don't think that, just hard direction swings, you know, like the pendulum is swinging harder and faster in each direction every time. It just feels like we're in a very unstable time. So I'm hoping that what you're saying is correct, that, as these shock waves happen, there's a calm afterwards, there's a settling afterwards. But we're looking down the barrel of, like you said, tariffs on February 1st. And so really nobody knows what's going to happen. So in terms of all of that playing out, you're on the front lines of mortgage lending. Are you seeing consumer confidence returning?
It's not directly, funny thing is consumer confidence, as much as it is related to a lot of the things that we're talking about, it's not always so simple. Like people don't just read the news and decide, right? People are emotional about their choices. People have children not because they are planning to populate Earth. They're planning children because they are emotional about the decision. People buy a home not because they're well, sometimes thinking about an investment, but a lot of times because they want to have a home. They want to have a place that they call their own. They want to make memories in that place with their kids, right? So although there is all this stuff happening, and a lot of it is not great. Like a lot of the stuff is negative, right? Um, there are sort of counter forces uh, with these emotional counter forces that are still stimulating some activity. And in addition to that, here in Canada, right, last year we've had some significant changes made to the insurability product to the insurability matrix, as I call it. Like we used to be able to only help first-time buyers with less than 20% down payment if they were buying a home of about $1 million, no more. But as of this month of January, we can qualify those same first-time buyers with minimal down payment for as much as 1.5 million, right? In addition to that, we can qualify them for that $1.5 million purchase on a 30-year amortization. So that segment of the market that's been unreachable for so long, especially considering that a lot of the Toronto core, right, a lot of the bigger municipalities, that's the segment of the market that is actually where you start seeing like detached homes and semi-detached homes of good value. So, there is this thing happening, which is directing all these first-time buyers, specifically millennials who have been sitting it out on the sidelines, partially because they weren't sure if they were really interested in buying a one-bedroom condo or two-bedroom condo. Some of them were thinking about moving out. Some of them are hitting the very pinnacle of their careers, making like just absolute bank. But because their rent's been $4,000 per month for the past 5 years, they have zero down payment, right? Or they have very little down payment. And so with this opportunity to buy upwards of 1.2, 1.3, 1.5 with as little as like 100 something thousand dollars, that's reachable. That's within reach. That's so different from just 1 month ago when to buy something worth 1.5, you would need literally $300,000 plus closing costs plus, land transfer tax. It's like $300,000. Like it's just not a common number for people to have. But now with these developments, right, with these policies and programs being really like centered around making these larger purchases more possible, there is already activity. Like if you look at the sales that are happening, like let's say this month of January, like I'm already seeing multiple offers on that specific segment of the market. Like if you're looking in like let's say the Leslieville area, like I was just reposting something this morning, one of my other contacts, they sold property 1.18 million, uh, multiple like 8 offers or something like that in like a week. I mean, that's happened last year too, but just not as common, not with as many offers. And I can guarantee you that when the seller was looking at those offers, there was a lot of people who were placing, or various people in that number of 8, who would not have been able to do it just about a month ago. So there is that also happening, right? So we will see activity. It will be patchy, and it will also be I think it's going to be in these cycles where we'll see everybody get really excited right now because there's all these new programs, right? And the rates are going down. And then if at the next rate announcement, nothing changes and the rate doesn't come down and just stays still, we'll see this. And then if we see the rate come down a little bit again, we're going to see this as well. But that segment of the market will be, I think, the one that if you have a property looking to sell, um, you are actually well positioned. Whereas if you have stuff over 1.5, you're just in about as bad position as you were about a month ago.
Yeah, so that's something that I'm seeing a lot too, is that there seems to be a sweet spot right now in the Toronto market for entry level freehold, which has always really, traditionally been the case. Entry level freehold has always been a very popular market, getting away from maintenance fees and things like that. which I guess leads me to the condo market, which is doing terribly. And
Terribly.
yeah,
Horrendous.
yeah. And I guess talk to us about that, like the holding costs on condos. Break those numbers down so people can really understand.
Sure. I can tell you with one sentence, if you're investing into condo market in Toronto, the only asset class that actually cash flows is micro condos.
Explain to me.
Well, because if you take a micro condo today in the month of January 2025, and you look at the average, listing price for a rental for those studios in downtown Toronto, they're like 1,700, 1,750, 1,800, maybe 1,900 if you're looking at the lake. When you're buying those condos, because they're not expensive, they're still in around that 350 to 450 range. Um, there's an interesting development that happened in the last years where a lot of the banks now require for you to put down 35% on micro units because they're not desirable for now. And that segment of the market actually has been completely ignored because of that reason. Because if you need 35% down payment as an investor, in percentage points, that sounds like a lot of money. But really, when you look at the actual figure, right, on $400,000, 35%, let's just do the math on this right now. $400,000 times 35%. It's about 140 grand. And so when you have a mortgage of only about 260 and it's like $1,000 and change, you got, property taxes of about 150, $200 a month. You get maintenance fee, and a lot of these newer ones are not very expensive. The maintenance fee, they're like 200, $300 a month. It's the only one that cash flows. Everything else does not cash flow. If you're buying a condo, you're buying it either because you understand you're going to be losing money if you're buying it as an investment, unless you're putting, again, gigantic portion of the down payment, or you're buying it because you're going to live in it. And that's not bad, right? Like people who are, and there are people, I'm not saying that condo market is completely toast. Like there's just too much inventory. Like, what do you want? If you had the same number of people looking for condos, and you had double in the inventory, well, you have half the amount of sales, right? So you have all this inventory, which is wild. It's just so much of it out there, especially in that 450 to 550 range. And that those are selling because people still want to have their own place, and those are still relatively affordable for somebody who makes about $100,000 a year. But that's the entry level purchase. Like $100,000 in 2025 with minimal down payment gets you into a $500,000 condo. That's it, right? So by virtue of that, young professionals who are hitting that 100K a year in larger municipalities, who are paying rent, they are starting to consider purchases over rentals because, well, the numbers starting to make a little more sense, right? Like if you were $1,000 short compared to what you were paying on rent versus a mortgage just last year when the rates were like you said, 200 basis points higher. Well, now 200 basis points lower, I mean, the gap isn't so wide, right? It's starting to make a little bit more sense. So people who are smart, like the ones that have been sitting it out and they're waiting for the opportunity, so to speak, and they're really paying attention, um, this is the time to go and get the condo you want because there aren't many people looking. So you're, by virtue of that, one of the very few who is considering. And so if you're looking around for those condos now and you're picking something with a view to the lake and a parking spot and all the upgrades and finishes, you could actually do quite well because there are so few buyers that the sellers are waiting for you to place an offer, right? So it's actually quite empowering for that segment of the young professionals that is making offers of about 100K and has about $25,000 down.
I guess investors then are running for the hills because they're not making it their primary residence. They
That's
might
right.
be able to cash flow on the smaller ones, but a lot of them didn't want those micro condos to begin with at up front unless they bought them pre-construction.
Yeah.
And if they did that when they were assuming rates were going to be lower, now they're getting killed. Um,
Yeah. Yeah. And then the condos that are coming due for closing right now, right? Like the ones that are being built, like the challenge with appraisal is still very real. Like last year, I don't know how many I had where people applied for a mortgage and we appraised the property. It was like $100,000 under or more. like condos that were 640 sold or 650 sold, appraising at 550, right? That's the real deal killer because now you have a whole cohort of people that bought these units that are just not valued the same. And even if you absorb all the down payment, there's still shortfalls sometimes, right? And I think that that's kind of like a it's kind of a, I guess, good thing for those people who are looking to buy, and it's a terrible thing for the sellers, for those people that put a lot of their money into these units, even if they weren't looking to just like make them investments, they were just literally looking to buy and close. Like how heartbreaking is it? You buy into a two-bedroom development, you've been paying your deposits on time, and then the closing time comes and you appraise your value, your property, and literally all your down payment has eroded.
So what happens in those scenarios?
What happens is if you're lucky, if you're one of those sellers where your condo appraised significantly below what you paid for it, and you just literally have like almost no reason to close, the best thing you could do is try to figure out an assignment sale to somebody that who wants it, and give up your deposits and forget about that down payment. I mean, it's been burned, right, in the process, and just get rid of the damn thing. Because if you don't, and the developer takes over the unit and it sells it on your behalf, well, now it may sell for less than you sold it for on that assignment or whatever. Or maybe you sold it to the next person that maybe it was like a partnership. You bought it with somebody. Sell your share. Let whoever can close, let them close if they have the money. You got to get out, and you don't have that down payment anymore. Your best case scenario is you get to walk out of it unscathed, which means that you don't have any legal recourse from the developer going against you. You don't have additional balances against you, right? No one is after you essentially, so you can move on and hopefully rebuild the wealth that you've lost in some other ways.
Wow. Yeah, it's a pretty tumultuous time out there, but it seems like
It's
there
tough.
is, yeah, it is tough, but it seems like there are some really good pockets of opportunity depending on, I guess, what position you're in and what you're looking for, what you're able to qualify for. There is opportunity. It's just, I mean, you got to step really carefully, it seems.
Yeah. You got anybody who is looking to execute this season of 2025, educate yourself. Like educate yourself early so that you don't have remorse later. Don't look at things emotionally, look at them logically. Try to educate yourself early on. Position yourself with a realtor that knows the market you're seeking to buy in, and get their help in making sense of it so that when you're looking through units, you're looking through stuff, you're aware of all the different things that are happening in that segment of the market, as well as what is happening with the general dynamic of the population. So you
Quick,
can go through these choices together.
quick question for you.
Yeah.
Gun to your head right now, someone's asking for your opinion on which of the big five are being the most friendly to lend to people, right now, as a lender. Which one would you say is, creating the least amount of trouble for consumers out there right now?
Well, it's none of the big five.
Okay.
And I will say something else. Like you have to remember that as a consumer, if you're looking at mortgage products, the products that are available through the big five banks, I mean, it's like just it's basically it's what everybody has, right? And none of those products are simple to qualify for. They're literally identical almost in what the banks are looking for, and there's nothing friendly about those policies. If you're looking for places that are going to make it easier for you to qualify, give you more power in terms of what you can qualify for, and give you different options in terms of amortizations and maybe payment terms, look at different products that are not the five big banks. Look through their broker channel. Talk to your broker about credit unions. Talk to your broker about trust companies. Talk to your broker about monoline lenders. Those are the ones that specialize just in mortgages. They don't care about your insurance. They don't care about your bank accounts. They don't care about any of that. They don't have 1,000 locations in every city of Canada. They just want your mortgage business.
Interesting. Wow. Well, thank you so much for your insight as always, Konstantin. Appreciate your time.
Pleasure.
Where can people find you?
Please follow me on Instagram at the Pocket Broker.
Awesome. And if you guys like this video, don't forget to hit that like button right below so you can help us push things out more to everybody. And also subscribe to the channel so you can join our community and get a lot more content like this. Thanks so much,
Thanks,
everybody.
Adam. Appreciate you.